Good morning and happy Monday, everybody. Today is November 13th, 2023. And the top story today, really, it was the top story Friday night. The U.S. credit outlook has been cut to negative from stable. First things first, let's get our terms straight. The U.S. credit outlook was cut over at Moody's, not the U.S. credit rating, which is the much more important term. What basically it is when they cut the outlook to negative from stable, they are threatening to cut the credit rating. So Moody's is the last of the big three ratings agencies to maintain AAA status for U.S. government debt. You may recall famously in 2011, we had Standard & Poor's cut the U.S. credit rating. And then earlier this year in August, we had Fitch cut the U.S. credit rating. Moody's is the last of the big three that still has a AAA rating on the U.S. government's debt. And they are threatening to lower that with their outlook cut to negative from stable. So why are they doing that? Why? I mean, Uncle Sam's good for it, right? Well, here we are again talking about another government shutdown. And what do we have to show for the last, 500 times we sat here talking about a government shutdown or all of the debt ceiling circuses? What do we have to show for that? Bigger deficits than ever. That's what we have to show for it. Every time we go through this ridiculous political exercise, this clown show in Congress, the stupid sound bites, the stupid speeches, and all the economic nonsense that gets thrown around. Oh, the rich should pay their fair share. Oh, we should cut spending. And nobody ever does anything to change it. The donors win every time, voters be damned. And so Moody's has said, you know what, we're late to the party anyway. Everybody else already cut the government's credit rating. I guess we should cut it too. Let's not do it real sudden, low. Let's kind of fire a warning shot first, even though it's a foregone conclusion. It's going to get cut. Why? Because nothing is going to change. We're a few days away from that next government shutdown. There is no plan whatsoever. There are some continuing resolutions being floated, and those continuing resolutions are already DOA when they arrive on the floor at the House. They're not going to get a vote. Well, they'll get a vote, but they won't win. And then anything that does get through the Republican-controlled House still has to get through the Democrat-controlled Senate and get signed by President Biden. They're not going to sign any spending cuts. And so nothing is going to happen. There's going to be no cuts to spending. They may say, oh, we're going to have a continuing resolution to fund the government through January or through February. Okay, so no spending cuts. And then February comes around. Now we're in an election year. What do you think happens then? You think they're going to cut spending or raise taxes during an election year? No. They'll just do nothing again. So cutting the U.S. government's credit rating, I think, is a foregone conclusion here. I'm amazed that Moody's has yet to cut it because let's be honest, folks, our government is hopelessly insolvent. Now, maybe they're not insolvent yet. They can still reach into the cookie jar that is the bond market and borrow a little bit more in order to keep their old debt paid off with new debt. It sounds a little bit like a Ponzi scheme. There's a little, not quite a Ponzi scheme. But sooner or later, that cookie jar is going to be empty. See also the reverse repo that broke below $1 trillion for the first time last week. Now it's back over $1 trillion right now. It's currently at $1.033 trillion, but it is trending down quickly. And if nothing changes, that will reach zero sometime in mid-February. And, well, nothing's changing. So the U.S. government's fiscal situation doesn't look that good. Also, the pile of unrealized losses on bonds continues to accumulate, and that's important for the health of the banks, and that's also relevant to the story about the U.S. credit rating, because what happens if U.S. government debt gets downgraded? Well, the price of U.S. government debt might drop further. And, well, U.S. banks are already sitting on a $650 billion pile of losses because the U.S. government debt has fallen so much. As interest rates have risen, bond prices have fallen. And remember, guys, when you give banks your money, when you make a loan to the bank, i.e. when you deposit it, the bank takes your money and they either issue loans, not doing much of that lately with the housing market frozen, or they buy U.S. treasuries. Those U.S. treasuries that they bought are falling significantly. Schwab getting in on the action today with their pile of unrealized losses getting even bigger. We just heard about that this morning. Also, we've got another cyber attack. Who's keeping track? We've got DP World, the biggest port operator in Australia, was hit by a hack, also announced in a Friday news dump last week. Now, supposedly some partial restoration of their systems has happened now. They'll be up to about a quarter of their capacity. with moving cargo around, but this is about 40% of the cargo in Australia flows through this one operator. So this is going to have an effect in Australia. We've got Tyson Foods, big maker, a big meat packing company. They announced their quarterly results today. People are eating a lot less meat because inflation. So congratulations to all of you unbearable vegans out there who have been saying for years how, oh, you don't like meat, and because you don't like meat, nobody should be allowed to eat meat. Well, inflation is achieving your vegetarian utopia anyway, as people are just trying to make ends meet. And so they're eating less beef and eating less chicken. And we got Boeing. It's having a great morning right now. A couple of good things going on for Boeing. We got some new orders. I believe it was out of Abu Dhabi in Turkey. Placed some orders for some new jets from Boeing. And there's the possibility that China may lift their ban on the 737 MAX. That's good news. It's got Boeing stock rallying this morning. And speaking of China and getting rid of the Boeing 737 MAX, that may be something that comes out of this big summit in San Francisco today. Apparently, Xi Jinping is going to be meeting with U.S. government officials. I don't know if it's going to be Biden or not. But good news, apparently we found the solution to homelessness in America's cities. Just have Xi Jinping come visit. Has anybody seen what happened to the homeless population in San Francisco and the needles on the streets? Where are they? They're all gone. They disappeared just in time for Xi's visit. Now, hey, if you're a resident of San Francisco, how does that make you feel? They don't care about you. Oh, but the Chinese premier is coming to visit. Quick, clean up the streets real fast. Never mind the filth that you've been living in this whole time. And where did they put them? Where did they move all these homeless people to? And wherever they move them to, are we going to get pictures of politicians standing in front of the fences crying and, oh my God, how could they do this to people? How could they move people around like this? What ridiculous political theater out of San Francisco this morning. Let's pretend like inflation hasn't driven people to live in tents and that the flow of fentanyl out of the very country who's coming to visit us up through our southern border hasn't resulted in these tent cities all over America. But I digress. And with that, let's shrink my big melon of a head and see what's going on in markets this morning. Just a reminder, guys, hit that like button. It really helps with the YouTube algorithm. And if you're new to the channel, hit that subscribe button. We do this every morning. Have your coffee with the melon heads. The fear-greed index is at 42 this morning, pushing back towards neutral. The S&P, though, is down about 14 points, about a third of 1% lower this morning. The Dow is down 57 points, about 0.17% lower this morning. And the NASDAQ is set to open 62 points lower, or 0.4% in the red. So we got all three of the major indexes are down ahead of the opening bell this morning. That is after a ripping week yesterday or last week for stocks. All three indexes were up big last week. Looking at the commodities board, December gold futures, $1,939. That's up about $1.50 this morning. December silver futures, $21.99, down below $22. That's down 1.3%, or about 29 cents this morning. And West Texas Intermediate trading at 77.58. That's for December futures, up about 40 cents or a half of 1% this morning. So commodities, not a lot of change going on. Silver's down a little bit. The U.S. dollar is marginally higher, 105.9. That's up about 4 basis points this morning for the Dixie. And looking at the bond market, it looks like yields are clawing back some of the losses from last week. 30-year Treasury is up 5 basis points at 4.785%. The 10-year yielding 4.681. That's up 5.5 basis points. And the 2-year at 5.07, up 1 point. 1 month at 5.398. Little change there. Looking at the medium-term chart of the 10-year Treasury, guys, this is going back to about January. Just want to show you guys this trend moving higher here. We are still above the 50-day moving average. So we dipped down below that in that big rally in the bond market last week, popped back above it after that bad 30-year auction that we had on Wednesday night. It looks like this uptrend is still intact, guys. Still above that 50-day moving average. So the bond bear market is not over, at least not according to this chart. Now, let's talk a little bit about what's going on here. Moody's cuts U.S. credit outlook to negative, citing deficits and political polarization. That's basically it right there, guys. Ridiculous government deficits, ridiculous political parties that will do nothing about those government deficits. And that's why they're cutting the credit outlook. And hey, Moody's, I have to ask, what changed? Is the deficits a new thing? Is the political polarization a new thing? What has taken you so long to get around to doing this? I mean, I would agree the deficits are getting worse and the polarization is getting worse, but this is not a new phenomenon. Let's just move on. Read a little bit here. Moody's Investor Service on Friday lowered its ratings outlook, not the rating itself, the outlook on the United States government to negative from stable, pointing to rising risks in the nation's fiscal strength. The ratings agency has affirmed the long-term issuer and senior unsecured ratings of the U.S. at AAA. So this is not a credit downgrade. This is an outlook downgrade. That's an important distinction. In the context of higher interest rates without effective fiscal policy measures to reduce government spending or increase revenues, Moody's expects that the U.S. fiscal deficits will remain very large, significantly weakening debt affordability. That is an understatement there. Brinksmanship in Washington has also been a contributing factor, Moody's said. Continued political polarization within U.S. Congress raises the risk that successive governments will not be able to reach consensus on fiscal plan to slow the decline in debt affordability. Guys, rising interest rates, shrinking tax receipts, spiraling deficits, political stupidity in Congress, all of these things contributing. I am still amazed that they have a AAA rating on U.S. government debt here. Honestly, I'm amazed that they still maintain this at AAA, but at least they're getting around to finally warning about it. Now, let's talk about some of the things that are causing this. First things first, here's the federal surplus or deficit. Oh, look, it was positive for a couple of years there in the early 2000s. Currently, though, the fiscal deficit in the U.S. for 2023, negative 1.7 trillion. And guys, yeah, that's a little bit smaller than it was in some prior years, but I would add we are supposedly not in a recession. We are supposedly not at war, at least not outright at war. I mean, we're having other people fight wars for us with our equipment, but we're supposedly not at war. It's peacetime. It's not a recession. Again, supposedly, why are we running $1.7 trillion deficits? And look at the trend here. This is not trending in a good direction. So that's one thing. Oh, and let's talk about federal tax receipts. Whoops, those are down. Current last quarter, 2.79 trillion in Q2 of 2023. That's down from 3.1 trillion in Q2 of 2022. But again, we're not even in a recession yet. So if tax receipts are already falling, what's going to happen during a recession when people start losing jobs and when there's less business activity? Well, tax receipts are going to go down. And I would also add that the entirety of this GDP growth, right? Remember the headlines last quarter, 4.9% economic growth. Okay, yeah, that sounded great, but it was driven by consumer spending, which is debt fueled, and 8% of GDP now is government deficits. So if we're serious about getting the deficit under control, then we're looking at an 8% hit to GDP. Well, if we do that, just the act of getting the deficits under control is going to shrink tax revenues, which means the deficit would start to grow again a little bit. So I don't want to say the situation is hopeless. I would say the politics is hopeless, but the only way out of this is incredibly painful, incredibly painful. There is no painless way out of this. There's no way out of these massive government deficits without a massive recession, arguably 1920s, 1930s level recession, or even depression. But the alternative is keep going the way we go, and we end up in some kind of a hyperinflationary scenario. And the politicians are just sitting there acting like, oh, do my way, and it's painless. There is no painless solution here. Now let's talk about the problem in the banking system, because that's not going away. Schwab's unrealized bond losses widened to $19.4 billion. Why investors should care. Charles Schwab's unrealized losses in a key part of its large bond portfolio widened in the third quarter to $19.4 billion as interest rates rose. Remember, when interest rates rise, the value of the bonds falls. Investors should pay attention. The losses expanded by another $4 billion from the second quarter because of a sharp sell-off in the bond market. See also that trend of the 10-year that is still intact. The paper losses of $19.4 billion are in a portfolio of U.S. agency mortgage securities with a face value of $162 billion. According to the company's 10Q report released on Wednesday, Schwab doesn't disclose it. For accounting purposes, the portfolio is classified as held to maturity. That means Schwab doesn't plan to sell these securities before they mature, and in turn won't realize the losses, a point Schwab emphasizes. In other words, this stuff is not worth as much as they say it's worth, but that's okay. They have 30 years to wait, as long as they can wait 30 years. But what happens if they can't wait 30 years? What happens if people decide they want their money back? Schwab would have to sell those assets at a loss, and they wouldn't have enough money to cover all of the withdrawals. That's what is going on at Schwab right now. And this is not a problem unique to Schwab. This is happening all over the market. Bond market crash leaves big banks with $650 billion of unrealized losses as the ghost of Silicon Valley Bank continues to haunt Wall Street. Now, just check out some of the numbers here. Moody's estimated last month that the U.S. financial institutions had racked up $650 billion worth of paper losses on their portfolios. That's as of September 30th. Things got a lot worse since September 30th, guys. That's up 15% from June 30th. The ratings agency data still doesn't account for a hellish October, where the longer-term collapse in bond prices spiraled into one of the worst routes in market history. Now, I would add that in the first few weeks of November, things have gotten a little bit better. But again, this decline in bond values, the increase in bond interest rates, that is still intact. These losses are not the same as debt, however, which describes actual borrowings that need to be repaid. Bank of America is the big lender worst affected by the crash in bond prices, having disclosed a potential $130 billion hole in their balance sheet last month. The other big four banks, Citigroup, JP Morgan Chase, and Wells Fargo, have all racked up unrealized losses in the tens of billions, according to their second and third quarter earnings reports. Now, here's the thing, 650 billion losses in the banking system, right? Now, that's unrealized losses. Again, they're not holding them on the books for what they're actually worth. But keep this in mind. Silicon Valley Bank failed in March after disclosing a $1.8 billion loss on its own bond portfolio, triggering a run on the deposits. Similarly, big banks have huge unrealized losses and are also sparking concerns among Wall Street doom mongers and Twitter randos alike, I'm sure. Wall Street doom mongers. Here's the thing, guys. A $1.8 billion loss on its bond portfolio because Silicon Valley Bank had to actually sell some of those bonds. So they couldn't just hide it using the held to maturity gimmick. They actually had to sell some of those bonds. And it only took a $1.8 billion loss to scare the crap out of their customers and start a run on that bank. Now, there is a $650 billion pile hiding at the rest of the big banks. And $1.8 billion in losses at Silicon Valley Bank was enough to trigger a bank run that caused the second, third, and fourth largest bank runs or bank failures in U.S. history. Do you understand the scale of the problem here? And they're just pretending it doesn't exist by saying held to maturity. In other words, as long as there's no price discovery, the banks are healthy. The moment that price discovery starts, the whole thing just grinds to a halt. And it only took $1.8 billion in losses at SIVB to cause that panic. Imagine what $650 billion getting realized. Imagine what that $131 billion at Bank of America could result in. Again, if they ever actually had to sell. Most people would say, yeah, the Fed will just turn on the money printer before that happens. Okay, great. But that introduces a whole other set of problems. Let's not get into those now. And let's talk about this Australia cyber attack. Leaves 30,000 containers stuck at ports. Operations resuming in Melbourne, Sydney, Brisbane, and Fremantle. Normal service won't return for a week, DP World says. DP World PLC is struggling to work through a backlog of 30,000 shipping containers piled up at ports across Australia as the company resumes operations after a cyber attack. Friday's hack on DP World, one of the largest port operators, triggered a company shutdown at the eastern ports of Melbourne, Sydney, Brisbane, and Fremantle in the west. While operations partially resumed on Monday, the investigation into the attack, as well as measures to protect the network, could disrupt service for days, DP World said in a statement. The company expects to ship 5,000 containers out of the four ports on Monday, less than a quarter of the typical daily volume nationwide. With local strikes also hitting DP World in the coming days, it may be next week before normal activity resumes in Australia. DP World manages almost 40% of goods flowing in and out of Australia, exposing the country to widespread economic and commercial fallout from an attack on a single entity. So, guys, this cyber war that is supposedly not going on, all nothing to see here, move along, everything strong and resilient, add to the Japanese interbank payment system, the Federal Reserve's ACH system, Mr. Cooper, ICBC Bank, and now the biggest port operator in Australia, all getting hit by cyber attacks. Nothing to see here. Move along. I'm sure everything is just fine. Let's talk about Tyson Stock. Falls on weak sales outlook, and people are eating less meat. Congratulations, vegans. Revenue of $13.3 billion fell short of expectations of $13.7 billion. Overall, fourth quarter volume slid 0.6% from a year earlier. An average price fell 1.4%. Within its beef segment, volume dropped 6.7%. The economy is so strong, nobody can afford a freaking hamburger. while average price rose 10.2%. Isn't that great? Prices are still going up even though people are eating less. Within the chicken segment, volume jumped 1.7%, while prices dropped 9.2%. Now, the chicken segment, I would add, a year ago, we were talking about bird flu. The avian flu was killing chickens by the millions. Farmers were having to cull their entire flocks. So I'm not surprised to see chicken prices down, but volume down 1.7%. People can't even afford chicken. While economic headwinds persist, we are moving in the right direction and managing what we control, President and CEO said during the earnings release. The company said that for fiscal 2024, the United States Department of Agriculture indicated that domestic protein production, which includes beef, pork, chicken, and turkey, should decrease slightly from 2023 levels, prompting Tyson to update the outlook for its segments. It expects sales to be relatively flat in 2024 compared with sales of 52.88 in 2023. That's 52.88 billion, while analysts have penciled in a jump to 54.37. So people can't afford to eat meat anymore, and Tyson stock is getting punished as of right now, down just 1.28%. It was down a few percent earlier in the day. Boeing, however, is having a much better day than Tyson is. Boeing leaps as Emirates place $52 billion 777X order, and China nears 737 MAX return. Boeing shares powered firmly higher Monday after the plane maker secured a $52 billion order for a 777X widebody, and reports suggested China is preparing to clear the way for sale of new 737 MAX jets into the world's biggest aircraft market. Emirates Airlines placed an order for 100 777X widebody jets at the Dubai Air Show this weekend. The two companies confirmed in a deal worth around $52 billion at list prices. The carrier is also buying 5 more of Boeing's 787 Dreamliners, taking its overall backlog to 35 of the flagship jet. Low-cost airline Fly Dubai also placed an order for around 30 of the 787 Dreamliners, its first ever of the wide body, while Turkey-based carrier Sun Express ordered 45 of the workhorse 737 MAX, with an option for another 45 jets as it looks to double its fleet over the coming decade. So great morning for Boeing, booking a lot of sales. Prospects of an embargo lift in China, and Boeing stock is up 3.6% ahead of the opening bell, trading at 203.75. So Boeing is having a better day than Tyson is, that's for sure. And I just want to say thank you. Oh, I got a lot of these guys today. Thank you very much to Dan Hedin. Says we're talking about the same people that rated triple D bonds as triple A. Can we trust anything they do? Should have graded lower and sooner. Hit that like button. Well, thank you very much, Dan Hedin. Appreciate the plug to hit that like button. And I believe, are you making a reference to, where is she here? Our ever vigilant ratings agencies who are all over that, right? Keeping a watchful eye on the creditworthiness of debts in the market. Yeah, same people. They did such a great job during the GFC. Now they're finally getting around to downgrading the U.S. government debt. And look, I would add, guys, that the last time during the Fitch downgrade that we got in August, remember I had Kieran Von Hest on the channel, and we did an interview, a.k.a. Deso Games on Twitter, and he found out, fantastic bit of research, that all of the mortgage-backed securities backed by Fannie and Freddie, every single one of them had been downgraded from AAA to AA because of the U.S. credit downgrade at Fitch in August, because the government guarantees Fannie and Freddie's bonds, and well, if the guarantor of the bonds has been downgraded, then the bonds that they're guaranteeing have to be downgraded too. So almost every mortgage-backed security in the country was downgraded by Fitch at the same time the U.S. credit rating was downgraded back in August. So if Moody's downgrades the U.S. government debt, it's not just the U.S. government debt that's affected. That will affect everything. Thank you very much, Dan Hedin, sir. I appreciate the super chat and the support of the channel, sir. And thank you, Nashville Pasta Man. Says, well, if we don't give them their rating, they'll just go down the street and get it from our competitors. What are we, in 8th grade? Do we have to bring her back up? I forget what her name was. Was it Georgia? What was her name in the movie? But yeah, that's what they said. It was basically just a rating shop. Well, if we don't rate them AAA, somebody else will. Now, in this case, Nashville, I think the downgrade or the threat of a downgrade, again, this is just the outlook has been lowered. I think this has a little bit more to do with groupthink than anything. I mean, it's become increasingly obvious that Moody's needs to defend that AAA rating while the others have already cut. So there is a little bit of groupthink among the ratings agency. Nobody wants to be the last one to cut that outlook. And well, Moody's, congratulations, you're the last one. And things have only gotten worse since the last cut in August. So what are you waiting for? But yeah, I agree. You know, rating shops and the ratings agencies just, yeah, I don't know how I want to say that. Asleep at the wheel, that's an overused phrase. They are not performing their vital function of informing investors of the underlying risks of investments. The ratings agencies appear to be more worried about appeasing their clients, i.e. the banks, the issuers of the debt, than they are about informing the investors in that debt of just how risky they are. In other words, a conflict of interest. Thank you very much, Nashville Pasta Man. I appreciate the super chat, sir. And thank you, KDM. I appreciate that. Prescribed meds haven't helped either. Happy Monday from a California visitor. KDM, I believe you're referring to the comment I made about fentanyl coming in across the southern border via China, by the way, with most of that fentanyl originates in China. And he's saying prescription meds haven't helped either. You are absolutely right, KDM. Our own pharmaceutical companies are not innocent in the fentanyl crisis. They have absolutely contributed to it. They get people hooked on prescription opioids. And eventually, when those people can't get the prescriptions anymore, the addiction remains. Fentanyl becomes the only way to scratch that itch. And, you know, it's different than when we were kids, when in the 80s, and, you know, people who ended up addicted were just people who were born on the wrong side of the tracks. It was things that happened to people on the wrong side of town. It's not just that anymore. I mean, that was bad, but it's everybody now. You know, a lawyer breaks his leg while he's skiing and he ends up hunched over on Kensington Avenue in Philadelphia because he got hooked on prescription pain meds and then ended up sticking fentanyl in his veins. I mean, it's different than it used to be, guys. There is so many problems around mental health, veterans coming back, you know, from over a decade of war, fentanyl flowing in across the southern border, poor mental health treatment in this country. So many reasons for the fentanyl crisis and the situation, the way things are. And you're right. There's no one person. You can't just assign the blame to one place, KDM. And our pharmaceutical companies are absolutely part of the problem. Thank you, sir, for the super chat, the support of the channel. Thank you, EC660, who is out from under his rock this morning, says, with reverse repo running out mid-February and bailout so-called loans due in March, I'm sure all is well. Your thoughts? Let me just say reverse repo is on pace to run out by February. I've been kind of hashing this out. How could they delay it? What will they do? Right now, we're still on pace to run out by February in the reverse repo, but that could change. There's something like $800 billion in the Treasury General account right now. Maybe the Treasury decides, instead of issuing so much debt in an election year, maybe we're going to start spending down the Treasury General account. And maybe that will reduce the rate of new bond issuance, and maybe that'll slow the drain from the reverse repo. I'm just grabbing at straws here. There's a lot of people who think that trend that's due to hit zero by February is going to level off. I don't know what's going to make it level off outside of the TGA being spent down. I don't see how they're going to be able to do that. But we'll see what happens. You know, I got my buddy Joe Brown over at Heresy Financial. He's been saying April. So he's kind of banking on a little bit of a slowdown also. I'm sticking with February until I see that trend change. And right now we're still on pace to reach zero in February. So thank you very much, EC660, sir. I appreciate that super chat. And thank you, Steve Woida says, even Keynes said government needs to pay off debt during good economic times. What happened? Keynes's idiot cousin, the modern monetary theorist, took over and decided government deficits never matter. And because we can just print more, it doesn't matter how much we borrow. That is literally the prevailing wisdom in modern economics right now. And, well, go to any academic institution in the United States, the people who are supplying these 400 PhDs that work at the Federal Reserve, there's nothing but Keynesian economics being taught there. So, yeah, Keynesian economics has morphed into modern monetary theory where, forget the Phillips curve, now it's just like, we'll just make more money and everybody can be rich. And, well, the inflation of the last few years is the result of that, and we all get to enjoy that. And now we're all going to be vegans, not because we're tree huggers, but just because we can't afford to buy beef or chicken. See also Tyson's earnings. But we'll have plenty of 777X wide-body jets to fly on, apparently. Thank you, Steve Woitis. Appreciate the super chat, sir, and the support of the channel. And thank you, everybody, for spending your morning with the Melon Heads and having your coffee here. I hope you guys have an awesome week. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Until next time, hi, Mom. Hi, Dad. I love you guys. Live small and dream big.